Well, hi, everybody. I'm Rick Edelman. Thanks for joining us on today's webinar. This is one of the most popular topics, judging from the number of folks who have registered and the number of questions we've been getting about it. It's all the rage, alternatives. And that's what we're talking about today, adding alternatives to create true portfolio diversification. And helping us talk about this, I'm very happy to bring on to this webinar Alan Steer. He is the portfolio manager for the Stone Ridge Diversified Alternatives Fund. Alan, thanks so much for joining us today on this webinar.
My pleasure, Rick. Nice to see you.
We have an awful lot to cover. We're going to jump right into it. If you have any questions, a lot of you already posted them, as I said, and we're going to pummel Alan with all those questions. We also invite you to post new ones. Go to the Q&A box here on Zoom. I'll be curating that as we go, and when I see questions that are germane to our conversation, I'll pump those to Alan as well. So we want to make this as interactive as possible. The fund, Alan, is SRDAX. That's the ticker symbol, SRDAX, Stone Ridge for the SR. I want, before we jump into the fund itself, I want to talk about you because your career is unusual compared to so many portfolio managers I talk to. You used to be a commercial airline pilot. Talk
Uh,
about that and
I
how
did.
that relates, how that experience relates to your day-to-day role as a portfolio manager today.
Yeah. So I did used to be an airline pilot. I flew for about 11 years for an airline called Continental Express, which is now part of the United Airlines system, and then flew for about 4 years for JetBlue Airways. Uh, Airplanes were always just one of my favorite things growing up, and it was just a lifelong dream to be able to fly those jets. Um, it's interesting to think about like what is it about being an airline pilot that might have any relationship to what I do today as a portfolio manager. And I think it can be distilled in simply saying that both an airline pilot and a portfolio manager at the highest level are risk managers. In the case of an airline, what they're doing as part of their business carries some inherent risk. You're going to take this very fast and complicated machine and move it from point A to B at a high rate of speed. Ultimately, it is the captain who's responsible for judiciously managing that risk, kind of making judgments about how to proceed in an ever-changing and ever-evolving environment that's typically, influenced heavily by the weather, but also do all that within a very strict regulatory regime that's all, put forward by the FAA. So as a portfolio manager, I also think that in essence, our investors expect me to judiciously manage risk. I do that within an evolving environment, which really is a market environment now, changing prices and economic dynamics. And I also do all of that within a very structured regulatory environment now, which is put forward by the SEC as opposed to the FAA. But what that means is I really spent my entire career in this risk management role, and in a very specific way, kind of managing risk in this judicious way within the backdrop of a pretty strict regulatory regime.
It had to be a little bit difficult to make that transition because I can tell you, having worked with so many airline pilots as a financial advisor, we teasingly joked with them that they were among the worst clients. Uh, because airline pilots know there's one way to fly the plane, and if you don't fly the plane correctly, it'll crash. And airline pilots are never going to do anything without knowing in advance what the outcome is going to be. But in the world of Wall Street, we don't know what the outcomes are. They're impossible to know in advance. So how do you reconcile the uncertainty of our industry with the training of yours as an airline pilot? That's a bit of a misnomer, right? A big misnomer.
Yeah, I think that it is funny to think that airline pilots were your worst clients. We can be a rather regimented group, I think. So I certainly believe in that. In fact, one of the things that we instituted as part of the management of our funds at Stone Ridge was a checklist and we were able to create that as part of an electronic and now very, really quite smart system that interacts with positions that we have in the portfolio. But our day starts out by looking at a checklist. And we check off the items on that checklist. It can be seen by all the people on the trading desk. And I think it's an example of how we take some of the commonalities. And your point is well taken. There's not universal commonality between being a portfolio manager and an airline pilot, but there are certain things that we've been able to leverage from that past experience in terms of how we operate on a day-to-day here at
Yeah.
Stone Ridge.
And when I say worst, I mean most challenging in a loving way.
Right.
Some of my favorite people are pilots, especially those who came out of the military.
Sure.
We've talked about Stone Ridge a little bit, but elaborate for us. Old Stone Ridge is not, let's face it, a household name in the asset management field. So give us some elaboration on the organization.
Yeah, so the company was founded in 2012 and with the specific goal of making it easier to access alternative investment strategies, all with the goal of improving diversification within an investor's portfolio. Today, some number of years later, we manage a little north of $28 billion. We have about 200 employees. We're headquartered here in Midtown Manhattan. And I think it's important to note that our focus has always been about alternatives. It's not some tangential part of a larger business. Alternatives are our business. And that level of focus, we think, has just been very important at finding ways to do some really innovative things, specifically within the 40 Act as it relates to this fund, bringing strategies that previously would have only been accessible in a private fund or some hedge fund form factor and making them more easily accessible, in this case, in a daily liquid 40 Act registered fund.
So let's start with the very beginning. This is a question we had from several folks. Why even bother? Why should investors think beyond just stocks and bonds? I mean, Markowitz said diversification is accomplished through stocks and bonds. So why go beyond that?
I think what it comes down to is that at the end of the day, even a diversified portfolio of stocks and a diversified portfolio of bonds, in essence, becomes just two things in periods of market volatility, or specifically market declines. You may own, a diversified portfolio of stocks, but when they start to go down, typically they all go down at the same time. It's as if you own one stock. And same for bonds. When they start to lose value, they tend to all lose value. It's as if you own just one bond. And so being able to diversify beyond just these traditional assets is quite valuable. It's very possible that had alternatives been more accessible at the time when Harry Markowitz, developed his award-winning theory about portfolio construction, alternatives may have played a bigger role in that.
So is it just thinking anything other than stocks and bonds counts as alternatives? Is that how Stonebridge thinks about it?
No, we have what I would describe as a very easy to describe and difficult to pass test for what we would think of as a viable alternative. And, really it has to pass through a filter that has three parts. The first of which is that we look for return streams that are positive in expectation regardless of the broader market environment. We would describe that as being persistent and pervasive positive returns. It should be positive, at least in expectation, regardless of what's happening with stocks, with bonds, with Fed interest rate policy, inflation, and the like. We also think it's very important that an alternative investment strategy have an intuitive rationale for profitability. It should just make sense to an advisor and, importantly, to their end client. Why would you expect to make money in this? And importantly, from time to time, understand why it is that you might be, suffering some losses. And then lastly, we look for strategies that have exhibited a very low correlation to traditional assets over an extended period of time.
Which, of course, is supporting the Markowitz premise.
Exactly. And I think what is interesting is that you can take a very large investment universe that is, broadly speaking, alts, and you can shrink it to a very manageable number of things by running it through that filter. At Stone Ridge, I think we're down to about 10 things that we think really pass that test. 6 of them we're actually able to make work within a daily liquid register fund that is CertX.
Wow. By the way, if you don't know, I've referenced Markowitz, Alan and I have a couple of times. If you don't know who we're talking about, Harry Markowitz, that's an indication that you should be hiring a financial advisor instead of trying to do this on your own. We're not going to spend time elaborating here on modern portfolio theory, but pretty fundamentally important to how you manage money these days. You mentioned that one of the key questions is this make any sense in terms of being able to make money?
Mm-hmm.
Talk about the flip side of that coin, which is risk reduction. Is what you're doing predominantly about making money, or to what degree is it also about reducing risk?
Really, it's both. The idea is that we do want to make money. We definitely seek positive return. It's that the sources of that return and the sources of the risk that underpin that return expectation. And I think that's important to acknowledge. There is no positive expected return without some undertaking of risk. Ultimately, it's our job to try to manage that in a judicious way, as I said, getting started. But we want to provide sources of risk and return that are simply unrelated to the things that are already in an investment portfolio. And it's that combination that reduces risk overall. That ultimately is, if I could really summarize Harry Markowitz, his Nobel Prize winning research yielded a result that said you can reduce risk without sacrificing returns by adding diversifying investments. And so, at Stonebridge, what we're really seeking to do is provide those diversifying investments. And so it shrinks portfolio volatility. It may not necessarily shrink the volatility of every individual line item within that portfolio.
It all sounds wonderful. I think it's the holy grail that investors and advisors are seeking: higher returns, lower risk. But
Right.
let's face it, alternatives have been around for a while, and a lot of investors have attempted this, and they've been frustrated and because of some of the pain points that they've experienced. So,
Sure.
talk about what those pain points are and how you managing SRDAX solve these pain points.
Yeah. So, I think first off that a lot of what's historically been easily accessible and called an alt is really a traditional asset that's been tortured in some way. Like, think about a call overwrite strategy. They're long equities and then you're short some calls. That's, I would argue, a traditional asset that's been tortured. And so what that means is that the correlation is high with traditional assets. And so the diversification and risk reduction benefit is typically not there. All of that's, also happens at a higher fee point, which can be painful. And in order to find things historically that really have been diversifying, there's been, this difficulty of the wrapper. It's in a private fund. It requires subdocs and AIQP requirements, and then you get K1s, and it just increases complexity significantly. What I think is really important about the Diversified Alternatives Fund is that it's a multi-strategy fund. And so it brings multiple investment strategies together, each of which has exhibited a low correlation with stocks and bonds, but each of which exhibits a low correlation with one another. And so you get this huge diversification benefit inside of the portfolio. It's also in a daily liquid registered 40 Act fund with a 1099 tax form. So it just fits into existing infrastructure. Historically, and at this point, the fund has over a 5-year track record. It's generated an equity-like return, but done that with a bond-like volatility and a near zero correlation to both stocks and bonds. So I think from that standpoint, has really delivered on its diversification promise. And doing that at this bond-like volatility has been important, I think, from a practical standpoint for investors seeking to allocate to alts.
By the way, many of you are already asking about a fact sheet and the web address. So we're going to pump that out right now to you in the chat. Michelle will post that so that you can look at the fact sheet about the fund, and also the link directly to Stonebridge's website to give you even more info. So Michelle will put that out in just a moment. Talk about, give me an example, just one example of the kind of asset that you would add in the category of alternatives to SRDAX that would be separate from stocks and bonds.
Yeah, I think the easiest one, the most intuitive one to understand is the fund's allocation to the reinsurance risk premium. Effectively, the fund acts as a reinsurer, insuring against natural catastrophe events. So said very simply, the fund receives premiums in exchange for taking on the risk that it would have to pay claims in the event of some very specific natural catastrophe activity. I think historically, insurance has been a very profitable business. It should tell us something that it's Warren Buffett's favorite business, or that typically any city that you drive into in the US, the largest building is the insurance company headquarters. The business model works. This strategy allows you to basically step into the shoes of a reinsurer. Now, it is certainly not without risk. There can be natural catastrophe events like earthquakes or hurricanes. The point is that that risk is simply unrelated to the things that drive returns in a traditional stock and bond portfolio. A hurricane does not form in the Atlantic as a result of a bear market in stocks or as a result of what Jerome Powell has announced for his Fed interest rate policy. It is a truly unique risk and return exposure.
That's a good example. You talk with advisors all the time. You see the data. How much do investors and the advisors recommend a typical allocation into this fund?
So we always recommend what I would refer to as a crawl, walk, run approach. And for many advisors that we speak with, an investment in CERDAX is their first allocation to an alternative investment strategy. So I do think there's sort of a minimum relevancy threshold, and typically we think of that as about 10%. And then what we have historically observed is that over time, as advisors have become more comfortable with that allocation, it's increased over time.
But where does that come from?
Yeah, so typically for this fund, at least, we see advisors allocating from their fixed income bucket. So what might have started out as kind of your stereotypical 60-40 allocation becomes 60-30-10, with 30% in fixed income, 10% in CERDAX. I think they've chosen to allocate from fixed income because the fund itself has a bond-like volatility and such a low correlation to the equity market. In fact, the correlation of this fund to the equity market is actually lower than the correlation of bonds to equities.
We'll talk about yield then, since people are using
Sure.
the debt side for income, you're taking it from that. Talk about that.
Right. So the fund does not target a stated yield. We make an annual distribution that's required. The fund needs to distribute its gains on at least an annual basis. We historically have done that in the middle of December of each calendar year. The fund really is managed for total return. It's just that the return stream that's delivered is bond-like in its volatility and exhibits such a low correlation to the equity market. And so I would say probably more broadly fits into an idea of a fixed income alternative. Mm-hmm. It doesn't act exactly like a bond in terms of spinning off regular cash flow.
Got it. It has an unusual or different availability than most funds. So elaborate on that, because that's a key point, I think.
Yeah, so at Stonebridge as a firm, we made a very intentional decision that we wanted to work with fewer number of advisors, but have those relationships be deeper. Fewer but deeper relationships. And so the way that we're able to do that or enforce that in a daily liquid fund like this one is that by default, although it may be listed on Fidelity or Schwab or some of these major custodial platforms, the default is that you can't buy it, which is sort of an interesting position to put oneself in if you're an asset management firm. You could bring up the ticker, you can enter in a buy order, and it will be rejected. What needs to happen is that we would come to know you and kind of make sure that you understand exactly what you're undertaking with an investment in this fund, kind of make sure that we're philosophically aligned in what that return experience is going to be. And then we will provide your custodian with your master account number and in essence sort of white label that account number, and then you would be allowed to purchase the fund going forward. What it creates is sort of an exclusivity benefit for the advisors who do have access to this. It's not something that you could just necessarily go down the street and check in with another financial advisor and they'd be able to put you in the same fund.
So that does create a value add benefit for the advisors, being able to offer their clients something that genuinely they cannot obtain on their own.
Correct.
And that raises a question from Larry, who asks about LPL. He wants to know if LPL Financial has any restrictions on the fund.
To my knowledge, LPL does not have any restrictions on the fund. I know that the fund is available on that platform. It should be able to be purchased there.
Okay. And Larry, if you have any need to follow up on that, just go to the web address we gave you to connect directly with the Stonebridge folks, and they'll be able to to tackle that for you for sure. Brandon wants to know about private equity and private credit. That's two big
Mm,
hot topics these days. Talk about those.
yeah. Uh, so those are two large asset classes in which Stoneridge does not have any position currently. And I think that comes back to the fact that, in our view, private equity is highly correlated with equities. I mean, it's in the name after all. And private credit, the same. Some people might think of those as alts or alternatives, but generally what you've got is an alternative liquidity profile, not really an alternative return stream. Like private equity returns are highly correlated with public equities, and private credit returns highly correlated with fixed income returns. So from our view, it doesn't meet that test about an uncorrelated return stream, and hence the reason why we have not been active in those spaces to date.
Kendall's wants you to elaborate. You talked about one example of what's in the fund that is in the alt category. Kendall wants another example.
Yeah. So another fantastic example of an alternative in the fund is its investment in art. The fund literally has exposure to paintings from the post-war and contemporary art world. So think paintings by Andy Warhol or Jean-Michel Basquiat. Stoneridge was the first asset management firm to be able to provide exposure to the art risk premium in a mutual fund form factor. And Surdax is an example of how you could get that exposure. It provides, really what I would call an alternative source of capital appreciation. So historically, the art market has had very attractive returns. Those returns have typically been highly uncorrelated to traditional assets. And so it's
So
another
that's
example of kind of an outside of the box thinking that we really like to think that we specialize in at Stoneridge.
Yeah, to say the least. I mean, that raises all kinds of questions. We know about custody of stocks and bonds. These are
Right.
securities.
Yes.
A Basquiat is not a security, it's a physical asset. So how are you buying it? Where are you storing it? Or is it in, I don't think it's hanging on the walls in your office. So
Right. That is correct. It is not. I mentioned getting started about operating within a strict regulatory environment that is the 40 Act. And of course, our art mutual fund needs to exist within that regulatory environment. It's very strict about the importance or the essential need to custody those assets. So our artwork resides in two facilities in Delaware, both called Delaware Freeports, that meet this custody requirement. The art, as a result, is not for public display. It's held in these free ports. It's in a crate in a fireproof holding and in a way that's protected until such time as we decide that we would like to sell that. That's kind of an interesting segue to the idea that within the art world, that's traditionally a very subjective market and one that's driven heavily by emotion. And we really think that we're at a tremendous advantage in that we manage an art fund specifically for investment returns. We make very objective decisions about valuation. We don't really care what color the painting is or whether it matches the wall or the couch in the room. What we're interested in is, do we get in at the proper price and are we able to exit at a price that delivers an attractive return to our investors?
and it's clearly 100% appreciation. It doesn't generate any income.
Correct.
And
Correct.
if it sounds kind of crazy to have art in a vault from a custody perspective, it's really, I guess, no different from gold funds or Bitcoin funds. I mean, these
Totally.
are, it's custody. Custody is custody, and as long as you're meeting the SEC rules on doing it right, what's the
Right.
big deal?
Right.
Um,
Exactly. Exactly.
the uh, I'm just looking at the questions that we're getting related to the LPL question, where the answer was essentially, yes, it's available on LPL. And if you're having any issues or questions about that, reach out to the Stoneridge team directly. A similar question's coming up about Schwab. Do you know if the fund is on the Schwab platform?
The fund is on the Schwab platform, but we would need to okay your account number on Schwab to enable the purchase of the fund. So
So
there
reach out to
again,
you.
we would need to reach out to us, and we'll set up a time to talk through the fund so you just fully understand at which point we can decide whether or not that's suitable for you, and we white label that account number.
Is this unique to this particular alternatives fund, or is this true for the entire suite of funds at Stone Ridge?
This is true for everything at Stone Ridge. This
Got
is
it.
really a firm-wide sort of stance across all of our investment products.
Well, it's certainly, I would imagine, reduced churn because you're going to weed out advisors that are either market timing or not taking it seriously or what have you.
Exactly. We're not interested in tourists in the portfolio.
Good way to put it. Good way to put it. We have somebody who's here with us today who runs a fund of funds.
Mm.
And can fund of funds invest with Stone Ridge?
Yes, they can. That, you know, maybe is a conversation for a sidebar conversation, really. But there's some very specific things that we would need to put in place, an investment agreement and so forth, in order to be able to facilitate that. But there are funds that have invested in CERDAC, so that is allowed, and it's even being done currently.
Yeah, and I'm sure that paperwork is nothing new to the fund of funds operations.
No, and nothing new to us. So it's something that we could put together with relative ease.
Another question is to compare what you do, how you do it, to liquid options that are often used by ultra high net worth clients.
Yeah, so I think liquid options, we're probably talking about overwriting long equity positions.
What you referred to as tortured.
Yeah, traditional assets is tortured. I think there's a place for it. I just don't necessarily view that as something that should be considered an alternative source of risk and return. It's
Got it.
maybe a yield enhancer, but it comes at the expense of giving away the upside on that holding.
What about made in America? As you're choosing alternatives, how much does that phrase matter?
Yeah, I'll tell you, it matters quite a bit to us at Stone Ridge. We are proudly an American firm and predominantly have American investors. That phrase "made in America," to me, when I hear that, I think of sort of using that as an input for choosing stocks or choosing bonds. I can tell you that within the fund's reinsurance exposure, most of the natural catastrophe or insured natural catastrophe risk in the world is in the United States. And so that is very much a position in which we are in a place where we help fellow Americans when a natural disaster strikes, whether it's a wildfire in Los Angeles or a hurricane in Florida. But it doesn't quite, it's a little bit of a square peg and a round hole in terms of thinking about alternatives, at least as is implemented by Stone Ridge.
Thomas is asking about weighting. I'm going to expand on his question about
Yeah.
the kind of weighting you do with the different strategies you engage in. How often do you change that? How much churn is in the portfolio, and so on?
Yeah, so we really think that a strength of this portfolio is that the weights are quite strategic. We don't spend a lot of time trying to tactically overweight or underweight. And in essence, what's inherent in that is it's saying we don't try to market time these individual risk premium. Each of them are in the fund in the first place because they passed that three-part test. They exhibit a persistent and pervasive positive expected return that's intuitive and that's uncorrelated. And we think the way that we can most consistently add value as portfolio managers is to think about efficiency of delivering those various risk premium. And that maybe happens in a less exciting way in that it tends to be rather small or incremental improvements, but those shavings add up to a pile over a 5-year investment horizon. That's as long as we've been operating the Diversified Alternatives Fund. Being able to guess which direction the market's going is a tremendous sugar high if you manage to pull it off. It just turns out to be like exceptionally difficult to do that in a repeatable way that legitimately adds value over the long term.
Resulting in the sugar crash.
Yes, exactly.
We have an RAA who's saying that they'd like to apply for access to use your funds and wants to know how to best go about starting all that.
Yeah, so the easiest way is on our website. And on the CERDAC's website, specifically at the very top, and I believe on the right-hand side, there's a method to sort of fill out requests for further information. You can do that, and a member of our client services team will reach out.
Great. So you've got in the chat the link, so you can just click on that link right now and access that. Javier is asking a really really good question. He writes, considering the type of assets that are in the fund, they appear to have low liquidity. So how are you able to
Mm,
offer high liquidity for daily subscriptions and redemptions? I mean, that Basquiat artwork that's in the vault in
yes.
Delaware, you can't sell that overnight, right? So
Yes. Certainly not. So, uh, a daily liquid fund within the 1940 Act is permitted to have up to 15% of its assets invested in what are considered to be illiquid investment strategies. By the way, the definition of illiquid, at least within the 1940 Act, means that it takes you longer than 7 calendar days to sell something. So it doesn't mean you could never sell it, but there's a very specific time frame. So we view that 15% limit is a hard cap, and so we manage the fund with more like a 12-ish% allocation to illiquid strategies. So you're correct, the fund's investment in art is classified as illiquid. There are certain investments that we've made within the reinsurance strategy that we also classify as illiquid. There are certain investments that we've made in our alternative lending strategy that we classify as illiquid. But about 88% of the fund is invested in such a way that we could turn it to cash within days. Um, Ultimately, we pay very close attention to liquidity. It's required in the 40 Act, you have a liquidity risk management program. We're able to manage or able to measure the size of the investments within the fund and compare them to the broader market. We sort of set a very low threshold, like a low percentage threshold that we're willing to represent of the overall market, with the idea that if we needed to sell that, we could do so without negatively impacting market prices. The results of that report land on the desk of our chief compliance officer every morning, and it's reviewed. But at the end of the day, liquidity is not something that keeps me up at night with respect to this fund.
so you're not saying that you only have 12.5% of assets in alts. You're saying that they're only in 12.5% in low liquidity alts.
That's exactly right. That's
So
exactly
give
right.
me a definition of,
100% of the assets in the fund are invested in alts.
got it.
But correct, it's the liquidity classification of just 12% of it is.
So give me an example of a high liquidity alt.
Yeah, so within the reinsurance strategy, again, we access that in two different ways. One is that we invest in catastrophe bonds, another is that we invest in a really bespoke, privately negotiated insurance-linked security called a quota share. The catastrophe bonds are a liquid investment. They trade every day and trade in significant size and in a way that's observable. And so most of our reinsurance exposure comes to the catastrophe bond market simply because of its liquidity profile. Whereas a quota share is a higher expected return. You take on more risk in exchange for that return, but it also has a very different liquidity profile. And so our investments in that are reduced as a result.
I know that we're going to get the question, so you might as well answer it now. Describe what that is.
Describe what a quota share is.
Yeah.
So it is effectively a pro rata slice of a reinsurer's book of natural catastrophe risk. And in exchange for that, you also receive a pro rata share of the premiums associated with that underwriting. So
So
it's
you're
basic.
taking some of the risk of a catastrophe, you're doing it in a portfolio, and you're getting a piece of the action.
Exactly. And we like those because it really increases diversification. That's sort of where you can get some exposure to things in Europe or Australia or like the like.
So we're getting an awful lot of evidence here, uh, Alan, about the level of interest people have in using this because this generally doesn't happen in our webinars, but it's happened several times already, and it's just happened again, where people want to know specifically where they're doing their business. And Sam is asking about Vanguard. Is this available on the Vanguard platform?
No, it is not available on the Vanguard platform, and I don't think it's going to be.
And you know what? I've been highly critical of Vanguard because they have taken a very paternalistic and absurd stance on crypto, saying the same thing. They're not going to allow crypto there either. And I accuse them of an inappropriate paternalistic attitude because who the hell are they to tell me what I'm not allowed to invest in? That's not their decision. That's my decision with my advisor. And so my simple argument is close your Vanguard account, go to Schwab where it is available. End of story. And here's a related question: is this suitable for an IRA account?
It is, and in fact, widely held amongst our own investor base in IRAs and other qualified accounts. I
And
think
that would
that's
seem
one
to
of
make
the
sense, right? Because um,
Yeah, I think that's one of the beauties of this fund and its form factor as a daily liquid register fund. It just fits like in existing infrastructure to include things like IRAs.
so we're getting some questions regarding the comments you made earlier about liquidity, and you said you're highly confident. You're not sleeping, losing sleep at night because of worries of liquidity, and that you're highly confident that you could liquidate pretty much the whole portfolio within 5 days.
Mhm.
Well, 5 days is a long time on Wall Street standards. So,
Right.
how quickly do you think you could liquidate? Within does that mean somebody who puts in a sell order today might literally have to wait several days before that trade settles?
Yeah, not at all. Any investor who put in a sell order today would receive their money tomorrow on a T+1 settlement. So you receive it the next business day. That is the definition of a daily liquid fund. You can invest on any day, you can redeem on any day. I'll tell you a story from earlier in the fund's life. This was in October of 2022. We had an investor, notwithstanding our best efforts to sort of screen against this type of behavior, submit a request to redeem for what was at the time a very significant percentage of the fund, about 4% of the fund's assets. I have a live feed of subscription activity as a portfolio manager, and I saw that redemption request show up at 3:45 p.m. I would argue that if you're running, say, a long-only equity fund or a long-only bond fund, if you see a redemption request for 4% of the fund's assets with 15 minutes left in the trading day, that can set off a pretty significant scramble. In our case, it does not at all. I casually picked up the phone and asked our operations department to sell, a few $1 million worth of treasury bills in order to sort of get the fund back to its unpledged cash position that we like. And the exercise was effectively over. You are able to, across a multi-strategy fund, a redemption request in essence is spread across the 6 strategies in the fund. And what that means is that you don't have to trade very much in any one of those 6. So it's really kind of a non-event as it turns out. But we plan to, we think of worst case scenarios. And so we think about what could happen. And the fund has access to a line of credit if necessary. The fund has access to repo agreements if necessary, none of which have ever actually needed to be used in 5.5 years. But those things are there in a kind of belt and suspenders approach for liquidity.
Got it. I've got a question here from one of our attendees. I'm not sure if this is relevant for your fund, but maybe it is. There's been a lot of conversation in the past several months regarding the challenges that are being faced by private equity funds, that they are experiencing a reduced liquidity, and that some of them are selling off assets or transferring assets from institutional investors to retail investors, and that the retail investors are essentially bailing out the institutional investors who are getting rid of their underperforming vintages. I know you're familiar with all this. Is any of that conversation relevant, applicable, a concern for your fund?
I think it's really not. And it comes from the fact that we publish a daily NAV and we're marking every single position in the fund every single day. And more than that, it's a third party who's marking that. It's the exchange publishes the settlement price, we draw that in, or we're using broker runs in certain cases to inform valuations in the catastrophe bond market. We have a third party that values all the fund's single-family rental and alternative lending investments, or in the case of the ART strategy, 15 independent appraisers who are providing valuations. So maybe some of the challenge in a private equity investment comes from the fact that it's not really marked in a transparent way, and so it's hard to know exactly, whether you're paying fair value for that. Within a daily liquid mutual fund, there's just no real concept of like a premium or discount to NAV.
Here's a pretty fundamental question. Talking about LPL, Schwab, Vanguard, and the like. Here's a more fundamental one. How can I convince my firm to let me do this?
We would love to help you do that. I think that the way that you can convince them to do it is that we feel like we've been pretty successful at solving what have traditionally been some of the real pain points of an allocation to alternatives. And that comes from the fact that it's in a form factor that's accessible. But I think it also really comes from the fact that we believe strongly in this concept of doing this in a multi-strategy form factor. That in essence, it means that your alternatives allocation is a single line item in an investment statement, as opposed to, say, 6 individual line items. If you take 6 individual line items, each of which is, basically uncorrelated with one another, at any given moment, one of those things is going to show a negative investment return, and that is going to turn into a conversation typically that disproportionately, let's say, disproportionately dominates a conversation between an investor and an advisor. Like, what is this weird thing? Why is it down 2%? You spend 75% of your meeting talking about something that represents less than 1% of the capital of the fund or of the portfolio. Doing this in a multi-strategy form factor just means that that volatility is kind of muted. In this multi-strategy form factor, it's more likely that it displays a positive return on any given month.
Naturally, people are asking about Fidelity.
It's available on Fidelity. But it would be the same exercise. We would need to approve your account number at Fidelity for trading in the fund.
Got it. 2 questions very similar. One, talk about the fee schedule, and second, talk about the minimum investment amount.
Yeah, so the management fee of the fund is 1.5%. And then there are some other fees and expenses, associated with it just being a 40 Act fund, compliance fees and so forth, mailing expenses that drive the expense ratio closer to 2%. The minimum investment in the fund is $500,000, but that is at the RIA level. So you could meet that minimum across multiple investors that have much smaller individual investments.
So do you care how small an individual account might be?
We do not care how small an individual account might be.
And what if the advisor says, well, I've got one client ready to go now with 10 grand. I'll get to the 500 eventually. Will that be okay with you?
Typically that is okay with us, but we do actually monitor and make sure that you get there over time. But yes, we would be willing to have a conversation about that.
Okay. A couple of folks are asking about crypto, noting that crypto is pretty much considered an alternative.
Yeah.
Do you agree? And is it in the fund?
Yeah, I do agree. I think it is an alternative. It is not in the fund. We actually previously had a sleeve in this portfolio that was a Bitcoin put right strategy. We sold short dated 1 month, 20% out of the money put options on Bitcoin futures. At the time that we implemented that strategy, Bitcoin itself had been a very volatile asset. It was an 80% realized vol. To put that in layman's terms, it meant that the price of Bitcoin historically went up or down about 4 or 4.5% every day. So pretty whippy. But what that meant was that the option premiums associated with those puts was also very high. So when we implemented that strategy in the fund, it met all of our sort of return and volatility and correlation characteristics. We thought as a standalone that strategy was maybe a 15 to 18% annual return. What happened over the next 2.5 years? The price of Bitcoin sold off over 50%. You would think, by the way, that the Bitcoin put right strategy would lose money in that environment. It was actually a positive contributor to fund returns. But counterintuitively, what happened is that the realized volatility of Bitcoin itself just collapsed. And along with it, the premiums that you could collect for selling that 20% out of the money put option collapsed as well. So what started out as a mid to high teens expected return strategy as a standalone suddenly was more like a 5% expected return. And out it went from the portfolio. We thought that was not a very attractive risk return profile.
It's interesting that a lot of people cite volatility as a reason for not liking Bitcoin. And what they aren't paying attention to, as you've noted, is that Bitcoin's volatility is declining dramatically. And it's now not nearly as volatile as, say, NVIDIA. So,
Right. Or some other things that you think of as more everyday assets like natural gas, for instance. But
so the good news is Bitcoin's less volatile. The bad news is if you were counting on the volatility for your returns, that
right,
game is over,
right,
or at least for the moment. Uh,
exactly,
so
exactly.
yeah, that's fascinating. Um, Talk about the fact that uh, you have a combination of low volatility and high volatility in the fund. Do you, aside from your hard cap of 12.5% in the low liquidity, do you associate low liquidity with high volatility? Are they unrelated to each other? And if they're unrelated, how do you compare the low vol with the high vol?
Yeah. So in terms of our portfolio construction, we think about a risk contribution coming from each of the 6 investment strategies in the fund. And, said simply, no risk contribution from any of those strategies represents a majority of the risk of the fund. We want it to be a true multi-strategy fund. And so, for instance, the reinsurance strategy is like 30% of the risk of the portfolio. Our market risk transfer strategy is about 30%. Alternative lending represents more like 15%. Single family rentals maybe around 7%, and art, say 1 to 2% of the risk of the portfolio. The beauty of it is that you combine those things together, and maybe all of those risk contributions add up to an 11% volatility. But because of the fact that those strategies have such a low correlation with one another, that volatility is offset, and what an end investor actually experiences is something closer to a 5. It's pretty amazing that you can take things like that, combine them, and the result is a volatility that's actually been lower than the US aggregate bond index over the last 5.5 years. But it's
Lance,
outperformed that index by about 50 percentage points.
that's pretty significant.
Yes.
Um, Lance makes the observation that there have been occasional significant declines in the NAV. Elaborate on that.
Yeah. So the first thing I would point out is that if you're looking at a decline that's in the month of December, that's probably a distribution that we paid. But you're absolutely correct. There have been periods in which the fund has experienced some drawdowns. I mean, I think the fund's a fantastic fund, but it's certainly not a magic fund that automatically goes up, a price chart that goes up and to the right every single month. So there have been some instances, an example of which was in September of 2022 when a very significant hurricane hit the Fort Myers, Florida area, Hurricane Ian. That caused a peak to trough drawdown in the fund of around 5%. At the outbreak of the Russian invasion of Ukraine, the fund also experienced about a 4.5% drawdown, really related to some price spikes in some agricultural assets. Talk about a unique source of risk and return. That has nothing to do with what's happening in the S&P 500 that causes the price of wheat to spike, 30%. So those are examples of the type of things that would create drawdowns in the portfolio. But I think what's important is that, first of all, we're talking about drawdowns that were like 4, 5, 6%. And we're also talking about it being the result of things that are completely unique and diversifying to the rest of the investment portfolio.
Are there comparable occasions where there have been upticks?
So in 2023, the fund returned almost 20%. And say that was a pretty right tail result for the fund. But interestingly, that followed the calendar year 2022. So at least so far over a calendar year period, 2022 was the fund's lowest return. It returned a little over 2% in 2022. You normally wouldn't get very excited about 2%, but relative to stocks and bonds, that was pretty good in that year. That was a year in which we experienced a hurricane, some price shocks related to the war in Ukraine, and each of those happened in these insurance-like strategies. And one of the reasons that we like insurance is that it really has sort of a built-in self-healing mechanism. And that self-healing mechanism is that when you experience a loss, you raise rates. in compensation for that loss, but also to improve sort of your go forward return outlook and restore what this, has historically been a very profitable spread between premiums received and claims paid. And so 2022 was a challenging year, but premiums in the reinsurance market and within our market risk transfer strategy were very high following that. And in 2023, there really weren't any natural catastrophe events, and it was also a pretty benign environment in terms of price volatility, and it meant that the fund profited very handsomely and in compensation for the fact that it experienced some headwinds to performance in the preceding year.
Uh, this is a mutual fund. Talk about the taxation. It issues a 1099 or a K1.
It issues a 1099, and it also makes one annual distribution, typically in the second or third week of December. Historically, that distribution's tax character has been about 80% income, and then the remaining 20% is some combination of short-term or long-term capital gains. It's sort of hard to anticipate that part in advance. It's very deterministic based upon what actually profited within the multiple strategies in the fund.
This has been an absolutely fascinating conversation. There's clearly a huge amount of interest in this. A lot of the questions we often get are more philosophical or big picture, high level kind of thinking. The questions we've had here today, Alan, are very tactical, very pragmatic about how to open an account and where to open it and taxation and minimums and such, which I think reflects a very high degree of interest about this investment. Give me some closing thoughts. What are the takeaways you want advisors to have from our conversation today?
Yeah, I mean, I think I would just leave you with the idea that we created this fund specifically with feedback from our clients. And in trying to solve what has historically been pain points in terms of allocating to alternatives, and that by creating a daily liquid multi-strategy fund that brings together 6 really unique and valuable investment strategies, the fund has been very successful at what I would say is solving both sides of the equation. It's delivered a very attractive return, vol, and correlation experience. But to your point about pragmatic, it also has a very practical view in that by creating or by delivering these within a multi-strategy form factor, it's just meant to make it easier. It's meant to make it less volatile. It's meant to reduce the pressure to pick the winner, like which one of those 6 is the best. Don't worry about it. They're all going to be positive contributors to the fund's returns over a long enough time horizon. The fund itself, has delivered very successfully over an extended period of time at this point.
Well, I think you've got a lot of things going for you here. There's a lot of interest, as we know, in alternatives. Advisors are looking for ways to diversify beyond stocks and bonds, but the vast majority of products that are out there suffer, I think, some inferior attributes compared to this fund. Number one, they don't have a long track record. It's certainly not a 5-year record like yours. Second, they're structured as VC, PE, hedge fund, private placement, meaning there's a very high account minimum of $500,000 or $1 million per client. They're illiquid. They have a 7 to 10 year hold. They've got a 2 and 20 fee schedule. Yours is just 2. There is no 20 on top, no carried interest. Yours is highly tax efficient because it's a 1099, not a K1. And it's highly liquid because it's a mutual fund structure, as opposed to an illiquid 7 to 10 year clock. And so for advisors who simply want to be able to say to their client, I want to give you exposure to alts, but I don't want to saddle you with the challenges that the traditional alternatives marketplace demands, I think that this is a winning product. And so I really think that it's of serious consideration by advisors, and I can see why you're getting so much interest and why we're seeing the kinds of questions we've gotten today from people who are saying, yeah, there's a there to this thing. So I think you're going to have continued success in attracting the interest of advisors and generating AUM. as a result.
Right.
Again, the links to both the fact sheet as well as Stone Ridge's website are all in the chat room. We encourage you to check them out because I think this is really worthy of consideration if you want to add alternatives to your portfolio. And like you said, in an investor intuitive, understanding way. I mean, you mentioned artwork. That's pretty clever. You mentioned catastrophe bonds. That's pretty obvious what you're talking about. And I think people can easily relate to these conversations.
Yeah, I mean, we sometimes talk about the fact that the strategies within the fund are really just very old ways of making money. We didn't invent the idea of providing reinsurance or invent the idea of owning art or making loans to high quality consumers and small businesses. But what we did do is find a way to make it available in this very easy to access investment product.
Well, this has been fascinating conversation, Alan. I really do appreciate very much the commentary here. It's been really insightful, very clear, very persuasive. That's
Great.
Alan Steer. He's the portfolio manager of Stone Ridge's Diversified Alternatives Funds, SRDAX, the ticker SRDAX, which you can access directly by signing up with Stone Ridge itself. I want to tell you as well that we have some additional webinars that are coming up later this week. In fact, on Friday, we have a webinar on understanding crypto staking, another big hot conversation. Next Thursday, on the 23rd, the case for an indexing in crypto. And then on October 30th, designing fixed income strategies for your clients today. QR codes to all three of those events are there on your screen. You can also just go to dacfp.com to register. Of course, all of our webinars are free for you. Our sole focus is to get you the financial education you need to be able to deliver solutions for your clients. So we're happy to be doing that. And if you want to become really proficient in crypto, it's the hottest topic out there, part of the alternatives conversation. You really need to become fluent in crypto, and the best way to do it is to get your CBDA, become certified in blockchain and digital assets. An online self-study course, you get up to 18 CE credits from a world-class faculty. Scott Stornetta, the co-inventor of blockchain, is on our faculty, for example. Anders Bromwell from the Boston Fed, and so on. Half the course on the tech, the other half all about practice management. You can learn more at dacfp.com or click that QR button. And be sure to read my Amazon #1 bestseller, The Truth About Crypto. And I'm happy to tell you of my brand new book that's coming out in December. December 4th, it launches on college planning. The Truth About College reveals the difference between going to college, getting it done right, and going to college and blowing it. 24% of freshmen drop out, only 62% graduate in 6 years. College can either put your teen on the path to success, or quite frankly, college can ruin their life. The Truth About College shows you the strategies you and your teens need to engage in to make sure the outcome is everything you want it to be. This is a terrific opportunity for advisors to show value add to their clients by sharing this book with them. If you pre-order now from your favorite bookseller, you'll get a special workbook containing the 20 conversation starters that parents can have with their teens, and opportunity to get access to a private webinar for those who pre-order the book. So go to your favorite bookseller and pre-order it today. And if you want to get your expert insights directly from me into your inbox, you can subscribe to our weekly newsletter here at The Truth About Your Future. There's the QR code. Alan, again, thank you so much for being with us today. It's been a real pleasure. I look forward to doing this again with you before long.
Likewise. Thanks a lot, Rick.
Thanks, everybody. We'll see you next time.
Take care.